welcome to Bullsmart Academy. The word stock and bonds are commonly used in the same sentence. However, they are two completely different types of investment. In this video, we shall see how bonds differ from stock. So let's start with the basic definition. A bond is a loan investment where an investor lends money to a company or a government, whereas a stock is a personal investment where a person buys a certain piece of a company. In other words, when an investor buys a bond, he is loaning money to the company or the government in exchange for interest, whereas when an investor buys a stock, he is buying the ownership of the company. Of course, when the loan is raised, a lot of terms are established, and the same is true with the bond. When a company raises money through a bond, it's called as new issue. In new issue, millions of worth of bonds are issued. A bond typically has a face value of $1,000. Face value is the original price of the bond when the bond is issued. The interest received on that bond is called as coupon. Now, for example, if a bond issues a coupon of $50, you will receive $25 every 6 months, as most bonds are paid twice a year. In this case, as the face value is $1,000, your interest rate is 5%. Now, the loan agreement ends when the bond reaches its maturity. So, maturity is the date when the bond issuer will pay the principal amount to the bond holder. Now, maturity can range from 1 to 30 years. The loan investment that are lesser than 1 year are referred to as commercial papers or bills. Bonds that mature in 1 to 10 years are referred to as notes. And the bonds that mature from 10 to 30 years are simply referred as bonds. Despite having the maturity of 30 years, some bonds can be paid off early, and those bonds are called as scalable bonds. Scalable means after a certain period of time. So some issuers can pay off the bond before its maturity, and in that case, the bond holder can receive all the interest up until that point, but once the principal amount is made, he or she will not get any future income. So let's review. Investor is investing in a bond. He is actually lending money to an entity like the company or a government in return for interest, and this interest is usually received in a semi-annual manner up until its maturity. So maturity is anywhere between 1 to 30 years. However, one should also keep in mind the credit risk of the issuer before investing in a bond. The issuer defaults, then no future income can be made. And on the maturity, the bond holder will receive his principal amount. So keep in mind, not all bonds are same. Some are secured, some are unsecured, with varying degrees of security, and different issuers have different varying degree of credibility. Also, different issuers give you different interest and different repayment schedules. So before you invest in a bond, keep all of these things in mind and then invest mindfully. Thank you.